In many businesses, expenses are paid before the benefit is received. When this happens, accounting rules require a specific accounting treatment known as a prepayment. A prepayment is an expense paid in advance. This means cash is paid first, but the benefit is received later. In accounting, we do not always recognize expenses immediately when cash is paid. Expenses are recognized when they are used or incurred, meaning when the benefit is received, not when the cash is paid. This is because of the accruals concept. The accruals concept tells us to match expenses to the period they relate to, not the period when cash is paid. Examples include rent paid before using a building, insurance paid before cover starts, and software subscriptions paid in advance. Let's look at where a prepayment appears in the accounts. A single prepayment affects 3 different areas, but not all at the same time. First, let's look at cash flow. Cash is recorded if and when cash is paid. Sometimes a business pays up front. Sometimes it receives an invoice and pays later. Either way, cash flow only cares about the actual movement of cash. If no cash has been paid yet, nothing appears in cash flow. Now let's look at the profit and loss account. The profit and loss does not show when cash is paid. It shows only the portion of the expense that is used or incurred during the period. For prepayments, that means we spread the cost over the months that receive the benefit. Each accounting period shows its own expense only. Finally, we look at the balance sheet. Any part of the expense that has been paid for but not yet used is shown here. This is called a prepayment, and it is a current asset. It represents a future economic benefit. The balance sheet shows what is left unused at the reporting date. Let's look at an example to see how this works in practice. The business pays rent on the 1st of December 2024. The amount paid is £12,000. This payment covers the period from the 1st of January 2025 to the 31st of December 2025, which is a total of 12 months. If we divide £12,000 by 12 months, the cost is £1,000 per month. Now, let's think carefully about 2024. In December 2024, the cash is paid, but no rent is actually used in that year. The building is only used from January 2025 onwards. So, in the 2024 accounts, the profit and loss account shows no rent expense because no benefit has been received. The balance sheet shows a prepayment of £12,000. This £12,000 is treated as an asset because it represents a future economic benefit that the business will use in 2025. Now we move into January 2025. In January, the business uses 1 month of rent. That 1 month costs £1,000. From an accounting point of view, this means 2 things happen. First, in the profit and loss account, we recognise a rent expense of £1,000 because that is the amount of benefit used during January. Second, in the balance sheet, the prepayment is reduced. It started at £12,000 and after using 1 month, it reduces to £11,000. A simple way to think about this is that we are moving £1,000 from the balance sheet into the profit and loss account. In February 2025, exactly the same process happens again. The business uses another month of rent, which again costs £1,000. So in February, the profit and loss account shows a rent expense of £1,000. The prepayment in the balance sheet reduces from £11,000 to £10,000. It is very important to remember that February's profit and loss shows £1,000 only. It does not show January plus February. Each month stands on its own. In March 2025, once again, 1 month of rent is used, so the profit and loss account shows another £1,000 rent expense. The prepayment reduces further to £9,000. Each month follows the same logic. The profit and loss account shows the expense for that month only. The balance sheet shows what is still unused. This same pattern continues every month until December 2025. Each month, £1,000 is charged to the profit and loss account. The prepayment reduces by £1,000. By the end of December 2025, the total rent expense recognised in the profit and loss account is £12,000. The prepayment balance in the balance sheet is £0 because the full benefit has now been used. Let's recap the key points about prepayments. Prepayments are expenses paid in advance. They are shown as current assets in the balance sheet. Cash is recorded when it is paid. If an invoice is received for a future period but has not yet been paid, there is no cash movement yet. Expenses are recorded when they are used or incurred. The profit and loss account shows the expense for the period. The balance sheet shows what remains unused. So far, we've looked at prepayments from the cash-first perspective, rent paid in advance from the bank. Now, we are going to look at the other very common business situation when we receive an invoice first and pay it later. This means we must deal with accounts payable, but the prepayment logic stays exactly the same. Here is our insurance scenario. We receive an insurance invoice in January 2025 for £9,600. The insurance covers period from the 20th of January 2025 to the 19th of January 2026, a full 12 months. The invoice is not paid until February, so we have accounts payable is involved. Let's deal with January 1st. 3 things matter in accounting: when the invoice is received, when the cash is paid, and when the benefit is consumed. In January, we have the invoice. We have not paid in January. We have only used part of the insurance. Because the insurance does not start on the 1st of the month, we cannot simply divide by 12. We must apportion by days, not months. Excel helps us do this accurately and consistently. We first calculate the total days of cover. Then we calculate a daily insurance rate. Finally, we calculate how many days were actually used up to 31st January. Total cover days is 365. Daily rate is £9,600 divided by 365. Days used in January are 12. January expense equals £315.62. Now we translate those calculations into accounting entries. Insurance expense in January's profit and loss is only £315.62. The remaining £9,284.38 prepayment in the balance sheet represents future economic benefit. Because the invoice is unpaid, the full £9,600 sits as a liability in accounts payable. Notice, we have both a prepayment and a payable at the same time. Now let's move to February. 2 separate things happen in February. We pay the invoice and we consume more insurance. Paying the invoice only affects accounts payable and bank. It does not affect profit. The February insurance expense comes from the same daily rate calculation, 28 days multiplied by daily rate. £736.44 is the February insurance expense that appears in the profit and loss. This expense is recognised whether or not the invoice has been paid. This reinforces the accrual principle. The prepayment balance is simply the opening prepayment minus January expense and minus February expense. £8,547.94 is the balance sheet figure at the end of February. March works exactly the same way. The only thing that changes is the number of days in the month. March runs from the 1st of March to the 31st of March. The insurance is active for the entire month, so we use 31 days of insurance in March. Again, we are focusing on usage, not payment. We already know the daily rate, £9,600 divided by 365 days. Daily rate multiplied by 31 days gives us £815.34. The daily rate stays the same, only the number of days covered changes. That's why March looks different from February and January. In March, we record £815.34 as insurance expense in the profit and loss. This represents only the insurance used in March. That leaves us with £7,732.60 as a prepayment at the end of March. This prepayment balance represents future insurance cover. Now let's look at the whole year 2025. Only the insurance used in 2025 appears in the profit and loss, not the full invoice. In the balance sheet at 31st of December 2025, one part of the insurance still relates to January 2026, so a prepayment remains. This reinforces the matching principle. To summarize it, accounts payable tracks unpaid invoices, cash flow tracks payments, profit and loss shows only what is used. Prepayments show future benefit. These are 4 different perspectives, and accounting works because we keep them separate.